Good day, everyone. So, in this project, our 500,000 portfolio includes five local stocks, one foreign stock, and one derivative, covering sectors like healthcare, tech, telecom, and manufacturing to ensure diversification and reduce risk. We started with five local stocks, added FKLI futures during the first rebalance and Microsoft Corporation during the second rebalance. So, key terms to remember is portfolio formation, selecting assets, rebalancing, which is adjusting asset mix, and also performance, which is measuring risk and return over time. In 2025, global economic growth is expected to slow down to 2.4% compared to 2.9% in 2024, mainly due to trade tensions and policy uncertainty. These issues have weakened business confidence, disrupted supply chains, and delayed major investment, especially with rising tariffs in US. So global inflation is projected to reach 4.3% in 2025 and decline to 3.6% in 2026, with advanced economies seeing the biggest changes. On top of that, world trade is forecasted to shrink by 0.2% in 2025 before recovering slightly by 2.5% in 2026. And the ongoing US-China trade conflict is reshaping global trade flows. Chinese exports to non-North American markets are rising, while US exports to China, particularly in sectors like textiles and electronics, are falling. So this opens up opportunities for new exports to fill in the gap. So now we are moving to local economic analysis. So in this context, it is Malaysian economic analysis. In 2025, Malaysia faces its own economic challenges, especially due to global pressures like US tariffs, seeing the US is one of Malaysia's key trading partners. These trade tensions may impact exports and overall trade performance. However, Malaysia is taking active steps to manage these pressures and maintain economic stability. Economics projects slower GDP growth between 4.5% and 4.8%, while RAM estimates a lower range of 3.5% to 4.5% compared to 5.1% in 2024. So despite this, domestic demand remains strong, supported by low unemployment, rising wages, and ongoing government development plans. Still, external risks remain, especially trade slowdowns in major markets like the US and China, and the threat of new US tariffs on Malaysia's key E&E industry. So this could become major obstacles for Malaysia's trade performance going forward. Moving on to external trade and also inflation rate analysis from 2013 to 2024, Malaysia's inflation rate has shown periods of both stability and volatility. Inflation stayed moderate until it peaked at 3.87% in 2017 due to rising oil prices and domestic policy changes. It then dropped to below 1% in 2018 and 2019, indicating weak demand. In 2020, Malaysia entered deflation at negative 1.14% due to the COVID-19 pandemic. As recovery took place, inflation rebounded to 2.48% in 2021 and rose further in 2022, before easing to 1.83% in 2024, supported by prudent monetary policy by Bank Negara Malaysia. On the trade side, Malaysia consistently recorded a trade surplus from 2013 to 2023, with exports peaking at USD 313.25 billion in 2022. However, both imports and export declined in 2023 due to global economic slowdown and also falling demand. The sharp increase in trade from 2020 to 2022 was driven by recovery in global markets and high demand for Malaysia's key export like E&E. Overall, Malaysia's trade and inflation trends closely reflect shifts in global commodity prices, industrial demand, and also external economic conditions.
The Malaysian telecommunication and media sector has seen volatility from 2021 to 2025, with the Bursa Malaysia Telecommunication and Media Index dropping from over 700 to below 500. Despite this, Celcom Berhad remains strong, reporting RM 3.21 billion revenue in Q1 2025 and a nearly 30% rise in profit before tax. The company is expanding 5G coverage and upgrading its network, aiming for 75% completion by the end of 2024. Stable dividends and growth in device sales and postpaid segment highlights its resilience amid sector challenge. The healthcare sector peaked during the pandemic but declined sharply afterward, with the Bursa Malaysia Healthcare Index falling from over 4,000 in 2021 to around 1,700 in mid-2025. KPJ Healthcare Berhad stands out with steady growth driven by hospital expansion and medical tourism. In 2024, KPJ revenue grew by 9%, showing operational strength. While the sector faces margin pressures and competition, KPJ offers stability and a defensive investment option. So moving on to our next industrial analysis, which is industrial product and services. The industrial sector experienced a boom in 2021, followed by decline due to rising costs and global uncertainty. The Bursa Malaysia Industrial Product Index dropped to about 152 by the mid-2025. Companies like Brass Metal Aluminium and Malayan Cement reflect this trend. Impact by commodity price swing and construction demand, recent optimism stems from low inflation and infrastructure projects, suggesting cautious recovery ahead. So, moving on to our last industry analysis, which is technology. For Malaysia, technology sector showed a sharp rise in 2021, then a correction through 2023, stabilizing around 51 points in 2024. It System Berhad benefits from growing smart city project despite sector volatility. Globally, tech giants like Microsoft have driven a strong rebound in 2023 to 2024, fueled by AI, which is artificial intelligence, and cloud computing advance. This highlights technology ongoing growth potential despite short-term fluctuation. So that's all for the industry analysis.
My name is Aidana Sabina and my metric number is 287928. This is fundamental analysis of Telkom Digi over 2022 until 2024. Based on the financial analysis, the best year for NPM was 2024, where the company achieved a margin of 12.36%. It shows Telkom Digi was most efficient in converting its revenue into actual profit in that year. Next, the highest ROE was recorded in 2023, standing at 10%. This reflects the company's most efficient year in utilizing shareholders' equity to generate profit. Also, EPS in 2023 also came out on top with a value 0.149. This was the highest profit allocated to each share during the period. The high EPS combined with improved ROE suggests 2023 was a peak year in terms of per share profitability and capital efficiency. Then the highest PE ratio in 2022 was 42.55, indicating strong investor confidence and growth expectation. Lastly, the MB ratio peaked in 2023 at 2.91, indicates strong investor confidence. In summary, 2023 was the Celcom Digi best overall year in terms of shareholder return and market confidence for Celcom Digi Berhad. Why choosing this stock? Because Celcom Digi Berhad stock selection is justified by its recovery and strategic development post-merger. Celcom Digi net profit margin increased in 2022 and 2024 despite a decrease in profitability in 2022. The company maturity and stability are supported by long-term infrastructure growth and an advanced 5G ecosystem. For KPJ Healthcare Berhad, the best performance is in 2024, indicate a strong recovery and operational efficiency after previous challenge. KPJ NPM reached 10.38% in 2024, the highest among the 3 years period, indicate its effective revenue conversion into actual profit. Similarly, KPJ ROE reached its peak in 2024 at 15%, indicating its strongest performance in generating return for shareholder. The increase from 11% in 2023 suggests that the company's strategies include cost optimization and expansion begin pay off. Also, the company EPS reached its high at 0.0759 in 2024, indicating a strong profit per share for shareholder. This indicates improved profitability and financial health supported by improved margin and return. For the PE ratio, PJ was the highest is in 2022 at 28.03. It's indicating high expectation for future earning despite the company's weakest year. The MB ratio reached its highest in 2024 at 2.30, indicate increased investor confidence in KPJ. In summary, 2024 was KPJ best year on showing strong financial health, profitability, and investor trust. Why choosing this stock is because KPJ Healthcare Berhad will show improved efficiency and better utilization of shareholder capital despite high cost and pricing ratio. The company's steady increase since 2022 and project growth until 2024 make it an attractive investment for long-term stability and healthcare sector yield. Next is fundamental analysis for Press Metal Aluminium. For this company, the year 2024 was the strongest overall in terms of operational and financial performance, showing significant improvement in core profitability and shareholder return. The NPM was its highest in 2024, reaching 14.25%, which reflects the company's best ability to convert revenue into profit during the 3 years period. But in 2022, ROE was slightly higher, which is 22%. This level signifies strong financial management and efficient investment strategies. When it comes to PE EPS, the best figure was achieved in 2024 with an EPS of 0.2143. It reflects greater profitability and indicates that shareholders earn more each share they have. Looking at the PE ratio, the highest was in 2022, standing at 33.68, while a high PE can signal strong investor confidence and high growth expectation. The MB ratio was also the highest in 2022 at 5.823, indicate that investors were willing to pay nearly 6 times the company book value. In summary, 2022 was the best year for Press Metal in terms of NPM, ROE, and strong EPS, showing it most efficient and profitable operation. Why choosing this stock? Because Press Metal Aluminium is a promising stock with promising performance in 2022 until 2024. Its net profit margin was 11.26% and its PE was 22%. By 2024, it reached 14.25% with robust EPS and a stable upward trend, indicate a long-term potential.
Assalamualaikum and hi, my name is Amir Shamim bin Yushari. My metric number is 294 and 956. I will present about the fundamental analysis in IT Mat System Berhad. Starting with 2022, despite financial challenge, the company delivered a strong net profit margin 37.8% thanks to solid cost control and profitability. The EPS stood at 23 cents, reflecting a healthy returns for shareholders. ROE was 33.89%, showing efficient use of shareholder funds on valuation. The PE ratio was 35.97 and the EB ratio was 5.11, indicating a strong investor confidence and premium valuation. In 2023, profitability improved further with the net profit margin rising to 42.2%, the highest in the 3-year period. However, EPS dropped sharply to 6.15 cents, possibly due to lower net profit or share valuation. However, EPS dropped sharp. However, ROE slipped slightly to 20.07%, suggesting a minor decline in capital efficiency. The PE ratio dropped to 29.1, signaling a more cautious investor sentiment, while the MB ratio rose slightly to 5.35, still showing strong market confidence. Last but not least, moving into 2024, we saw a slight drop in profitability, with the net profit margin falling into 36.5, and however, EPS increased to 7.8 cent, hinting at a recovery in earning. ROE improved to 21.6%, suggesting a better capital efficiency compared to the previous year. Interestingly, the PE ratio jumped to 47.29%, 47.29, possibly indicating higher investor expectation or overvaluation. The MB ratio surged to 9.47, showing that investors were willing to pay significant premium, likely driven by growth prospect or strategic positioning. That's all for me. Okay, I will continue to fundamental analysis for Malaya Cement Berhad, Cement. Starting with 2022, it was a modest year for the company. The net profit margin stood at just 3.09%, meaning only a small portion of revenue turned into profit. EPS was 12%, signaling limited earning for shareholders. ROE came in at 1.97%, indicating a low return on shareholder equity. Despite this, PE ratio was 34.5 and MB ratio was 0.5, meaning the stock was trading below its book value, a sign that the market might have a concern about the company performance for future prospect. Moving to 2023, we saw a sign of movement into the net profit margin, which is increased to 4.23%. This is reflecting a better cost efficiency and profitability. EPS increased significantly to 0.33 cent, suggesting a jump in earning or better earning distribution. ROE improved to 2.71%, still low but showing progress in the company ability to generate returns. The PE dropped to 25.29, bringing a market valuation more in line with actual earnings. And the MB ratio was 0.68, indicating a rising investor confidence and stronger alignment between book value and market price. Last but not least, we going to 2024, the company posts its strongest result yet. The net profit margin surged to 9.64%, showing a substantial profitability. EPS grew to 40 cents, highlighting a continued earning growth. ROE jumped into 7%, demonstrating much better use of equity capital to generate returns. Interestingly, despite this gain, the PE ratio declined to 50.48%, suggesting that investors now view the stock more conservatively or perhaps saw it as more fairly priced. As the MB ratio engaged edged at up to 1.05, meaning the stock was now valued slightly above the book value, typically a sign of healthy market confidence. That's all for Fundamental Analysis Malaysia member. Okay, last but not least, for Microsoft Corporation fundamental analysis, starting with 2022, Microsoft delivered a strong profitability net profit margin of 33.05% and an impressive return on equity of 43.68%, showing as an excellent return on shareholder capital. The earning per share was 9.65, indicating a solid earning per share for investor. The price to earning ratio stood at 26.6, suggesting a healthy but reasonable market expectation. And with a MB ratio of 11.56, investors were clearly willing to pay a substantial premium over book value, signaling a high confidence in Microsoft fundamental and future. In 2023, the company showed improved profitability with the net profit margin rising to 36.27%, a great sign for operational efficiency, while EPS rose slightly to 9.68. ROE declined to 35.09%, meaning Microsoft was still highly profitability but slightly less than a year before. The PE ratio jumped to 33.9, reflecting a growing investor optimism and higher expectation. Meanwhile, the MB ratio increased to 12.3, reinforcing her continued confidence in the company long-term value. Last but not least, in 2024, profitability dipped just a bit with the net profit margin easing to 35.43%. Still a strong figure. More importantly, EPS increased significantly to 11.8, suggesting a meaningful earning growth. However, ROE fell again to 32.83%, indicating a slightly reduced capital efficiency, possibly due to slower net income growth. The PE ratio decreased slightly to 33.8, which shows that investor valuation of the stock remaining largely consistent. The MB ratio edged up to 12.64, signaling ongoing confidence in Microsoft market value and prospect. That's all for fundamental analysis for the six company that we have been choosing. Thank you.
The FKLI is a stock index future contract that follow the development of the FBM-KLCI, which is the benchmark index of Malaysia listing the 30 biggest and most market liquid companies on the Bursa Malaysia. FKLI is normally cash settled and traded at Bursa Malaysia Derivative by each valued at 50 ringgit times the index value. FKLI is one of the most liquid derivatives being traded in the country. Investors may use FKLI as a multi-purpose instrument in hedging, speculation, or portfolio management. FKLI may be used by investors to hedge against the declining market, alter the sensitivity to beta, or speculate on the movement of the Malaysian equity market in the short term. However, FKLI can be an important tool in risk management and positioning portfolio to market change, since domestic GDP growth slow down, interest rates are expected to be reduced, and portfolio are to face greater volatility because of global uncertainty. Why choosing this stock? Because in May 2025, the FBM KSL fell by 2.2% to nearly 1,508 due to global trade tension and investor caution. Malaysia GDP slowed to 4.4%, with inflation dropping to a 4-year low. Bank negara Malaysia suggests reducing interest rate to boost domestic demand. This has led to market volatility and foreign fund outflow, putting the investment environment uncertain. FKLI can be useful instrument in the first rebalance period to react quickly to market fluctuation, either shorting to hedge against downtrend or going long to capitalize on recoveries. So that's all for the fundamental analysis.
29 are representing our initial portfolio formation process. We conducted our initial portfolio formation on 2nd January 2025 involving 5 selected local stocks. Instead of equal weighting, we applied financial modeling techniques to optimize the portfolio under specific assumptions. We selected 5 local companies based on fundamental analysis, which are Celcom Digi Berhad, KPJ Healthcare Berhad, Press Metal Aluminium, Malayan Cement Berhad, and ITMAX System Berhad. Using daily market data from 1st January 2023 to 31st December 2024, we computed daily returns via log normal return formulas in Excel, then analyzed mean return and variances by multiplying 252 trading days. Table 5.1.1 shows ITMAX had the highest annual return of 48.04%, followed by KPJ at 46.02%. At the same time, CDB had a negative return of 3.57%. KBJ offered a variable risk return profile with moderate returns and lower volatility compared to others. The market index FTSE Bursa Malaysia KLCI had an annual return of 5.56% and standard deviation of 8.55%. We calculated covariance manually to understand relationships between stocks and to compute beta values using the CAPM formula with a risk-free rate of 3.828% based on the 10-year Malaysian Treasury bond. At the next step, all stocks showed positive covariance with each other and the market. P Metal had the highest beta of 1.1889, while KPJ had the lowest beta of 0.5933. Required returns range from 4.86% for KPJ to 5.59% for CDB. Next, we calculated correlation coefficients via Excel's data analysis tool. The correlation coefficients were all positive but weak, which is all below 0.3, indicating low correlations among stocks. CDB and P Metal had moderate correlation with the market index. In addition, by using Excel solver tool, we optimized stock weightings to maximize the Sharpe ratio under three constraints. First, allowing short selling with the minimum weight of 75%. Second, maximum weight of 150%. And third, rates can be negative. This approach controls downside risk by short selling CDB and P Metal while leveraging KPJ, MCBAN, and ITMAX for higher returns. The optimal portfolio weights were negative 34.88%, 70.91%, negative 13.61%, 27.49%, and 50.9% for CDB, KPJ, P Metal, MCBAN, and ITMAX respectively. With this weightage, we are expected to achieve an expected annual return of 69.86% with standard deviation of 27.23% and Sharpe ratio of 2.425. The portfolio lies on the efficient frontier as shown in Figure 5.111, indicating it is an optimal portfolio with the best risk-return trade-off, with the capital market line anchored at the risk-free rate of 3.828%. Comparing actual returns to cap and required returns, KPJ, P Metal, MCMAN, and IT Max outperformed expectation. However, short selling CDB led to a loss due to its price rise. In conclusion, KPJ was the best performer with an actual return of 18.11% versus a CAPM required return of negative 4.67%, while CDB was the weakest with actual return of negative 1.91% versus a CAPM required return of negative 1.23%.
Good day everyone. Today I will walk you through the performance evaluation and rebalancing of our investment portfolio as of 2nd January 2025. We restructured the portfolio using 2 years of updated historical data from January 2023 to December 2024. It consists of 6 stocks and 1 derivatives, the FKLI, which is a future contract on the KLCI index. We computed daily log normal returns and then analyzed them for consistency across financial analysts. This included multiplying daily returns and variances by 252, representing the number of trading days in a year. From Table 5.2.1, KBJ Healthcare performed the best with a return of 22.74%, likely due to higher demand for healthcare post-pandemic. On the other hand, Inmax achieved a modest return of 3.49%. However, the market itself shows bearish trends with FKLI and KLCI yielding, which is negative 6.01% and negative 5.69% respectively. In terms of volatility, Inmax was the most unstable with a standard deviation of 23.23%, while FKLI was the most stable at 9.69%. To assess the risk exposure of each asset, we use the CMPM model. This allows us to calculate expected returns based on the 10-year Malaysian Treasury bond as the risk-free rate, which stood at 3.828%. We then constructed a covariance matrix to understand how the asset's core movement, as shown in Table 5.2.2. KVJ and Inmax show high core movement, which is 1.9482%, while CDB and Inmax had a slightly negative covariance indicating opposite trends. Beta values further explain the market sensitivity of each stock. Inmax with a beta of 1.5970 is highly responsive to market fluctuations, while CDB
lower beta shows more stability. Table 5.2.3 shows the correlation matrix. FKLI and KLCI had the strongest correlation at 0.9190, which is expected as they track the same index. Most assets show moderate to strong positive correlation with minor negative values such as DB and KPJ at negative 0.0196. In portfolio construction, our goal was to maximize the Sharpe ratio. Using optimization in Excel, we assigned weights to each asset. KPJ was overweighted at 120.69%, while some assets like P-metal and FKLI were shorted. Despite our initial non-negative constraint, the final expected return of the portfolio was 35.17% with a standard deviation of 23.80% and Sharpe ratio of 1.3168, which is considered a moderately good risk-adjusted performance. Now looking at figure 5.2.1, we visualize the capital allocation line and efficient frontier. Our portfolio, marked as the green dot, lies exactly on the efficient frontier curve, proving it is optimal under the Markowitz portfolio theory. This means we are achieving the best possible return for the level of risk we are taking. To evaluate performance further, we compare the actual return of each asset with its CAPM benchmark. As shown in table 5.4.3, only Inmax managed to beat its expected return, achieving 2.11% versus the CAPM benchmark of 1.53%. Other stocks fell short. For instance, KPJ delivered negative 6.21%, lower than its CAPM of negative 5.31%. CDB and Maximum also underperformed, showing that while our model is theoretically sound, real-world outcomes are diverged due to external market pressures. In conclusion, the first rebalance portfolio shows strong construction in theory, aligns with efficient frontier expectations, but also highlights the importance of continuous monitoring and adjustment due to the market volatility. Thank you.
Good day, Doctor. I'm Tan Mingjun. Number matrix 292738. Today, I will present the key insight from our second rebalance portfolio, which was constructed on 3rd June 2025. This rebalance included 7 assets, covering both local and international stocks, as well as 1 derivative. The portfolio consists of 5 Malaysian stocks, Celcom DG, KPJ, Press Metal, Malayan Cement, and IT Max. The 1 international stock, Microsoft Corporation, and 1 derivative, the FTSE Bursa Malaysia KLCI Future or FKLI. We use daily data from 1st January 2023 to 30 May 2025, and returns were calculated using log normal returns, which were annualized. Since Microsoft is priced in USD, we convert it to MYR using exchange rate from early 2025. We use the CAPM model with a risk-free rate of 3.828% to assess expected returns. The risk-free rate is following the 10 years Malaysian bond. From the analysis, KPJ Healthcare showed the highest annual return at 14.62%, indicating strong performance. However, both FKLI show a negative amount at negative 9.07%. The KLCI index had negative returns, means that the overall market remained bearish during this period, so that the market environment now is tension. In terms of volatility, there are 4 assets are above 20% of standard deviation. ITMAX had the highest standard. Besides, we use CAPM to compare expected and actual return with risk-free rate at 3.828%. By using the covariance matrix, we observed that the most stocks had positive relationship with the market except Microsoft, which had negative covariance and correlation. This means Microsoft moved in the opposite direction of the Malaysian markets, which is valuable for diversification. From the table, it also showed the highest positive beta, which is ITMAX at positive 1.47, means it is sensitive to the market. While for highest negative beta, which is Microsoft, it is negative 0.27, means it is inverse market movement. In addition, all assets positively correlated with KLCI except Microsoft, and it is good for diversification. The strongest correlation with the market was shown at 0.9189 with the pair of FKLI and KLCI, while Microsoft had a negative correlation compared to this asset. Next, we optimized the portfolio using Excel to achieve the highest Sharpe ratio of 1.0530. The portfolio had a high allocation to KPJ at 49.48% and Microsoft at 39.23%. FKLI had a negative weight, implying a short position. This is a theoretical outcome based on the theoretical model. The figure 5.3.1 show the efficient frontier for second rebalance. The final expected annual return was about 18.56% with a standard deviation of 13.99%. And the portfolio lies on efficient frontier, meaning that it is considered optimal. Finally, we compare actual return to CAPM benchmark. From the result, only Press Metal and Microsoft performed above expectation. For example, Microsoft especially stood out with an actual return of 5.58% versus a CAPM return of 3.79%. On the other hand, ITMAX and Malayan Cement underperformed significantly. For example, ITMAX missing its CAPM target by over 7%. In summary, this rebalance achieved diversification through international exposure, and it identifies strong and weak performance and deliver an optimal portfolio on the efficient frontier. That's all for my part. Thank you, Doctor.
Good day, Doctor. My name is Tani Chong with matrix number 293145. Now I'm going to present about the portfolio benchmark in which we compare our portfolio performance with the market performance, which is the KLCI. From the initial portfolio formation period, which was started from 2nd February 2025 to 3rd May 2025, the portfolio achieved a strong return of 18.17%, while the market declined by 5.69%, which resulting in an outperformance of 33.86%. During the first rebalance period, which was starting from 4th May to 31st May 2035, the portfolio recorded a loss of 6.97%, while the market declined by 7.93%. Therefore, despite there are losses due to stock prices declines, our portfolio is still able to slightly outperform the market by 0.97%. In the second rebalance period, which was starting from 1st June to 24th June 2025, the market began to recover with a return of 0.73%, while the portfolio return recorded losses of 1.99%, which indicating that our portfolio are underperformed the market by 2.72%. This underperformance was mainly due to our expectation that the market's downward trend would continue, but unfortunately the market was under recovery. In this slide, I'm going to discuss about our portfolio return. We began our investment with 500,000 by dividing this fund among several stocks based on predefined vintage. During the initial portfolio formation period, which was starting from 2nd February to 3rd May 2025, the portfolio grew to 590,830 ringgit 59 cent, yielding a strong profit of 90,830 ringgit 59 cent or 18.17% profit. However, in the first rebalance period, which was starting from 4th May to 31st May 2025, the portfolio value dropped to 549,677 ringgit 99 cent, marking a loss of 41,152 ringgit 60 cent or negative 6.97%, primarily due to declines in Celcom Digi Berhad and KPJ Healthcare Berhad, which held the largest weightage in our portfolio. In this period, we adjusted the stock weightage and used FKLI futures to reduce our portfolio risk. In the second rebalance period, which was starting from 1st June to 24th June 2025, the portfolio slipped further to 537,896 ringgit 70 cent, losing 111,781 ringgit 29 cent or negative 1.99%. This happened mainly because FKLI futures went up, but we had a short position on it, meaning we lost money when the price roses. As a conclusion, the final portfolio still achieved a total profit of 37,896 ringgit 70 cent, and the total portfolio value is 537,896 ringgit 70 cents, resulting in an overall return of 9.21% from the initial capital 500,000, even with the losses at first and second rebalance period. That's all from me. Thank you.
Moving to conclusion. So, for this project, our portfolio applied real life financial strategies like CAPM, mean variance optimization, and the Sharpe ratio. We had a strong start, gaining 18.17% from top performing local stocks like KPJ and IT Max, using tools like solver, short selling, and leverage to balance risk and return. Although we faced small losses during rebalancing due to market volatility and also FKLI positioning, the portfolio remained on the efficient frontier. In the second rebalance, we added Microsoft for global diversification, which helped lower the risk in our portfolio. So in the end, we achieved a solid 9.21% net profit, showing the importance of strategy, monitoring, and also an adaptability in real markets. So that's all from our project. Thank you very much.